Today, APRA bowls a wet lettuce. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. This morning, APRA has announced changes to the minimum interest rate buffer that it expects banks to use when servicing home loan applications. In a letter to authorised deposit-taking institutions, or ADIs, APRA has told lenders it expects they'll assess new borrowers' ability to meet their loan repayments at an interest rate that is at least 3 percentage points above the loan product rate. This compares to a buffer of 2.5 percentage points that is commonly used by ADIs today. Quick pause there. Of course, some banks have already lifted that above 3%. APRA's decision, they say, which reflects growing financial stability risks from ADI's residential mortgage lending, is supported by other members of the Council of Financial Regulators, which of course include the Reserve Bank of Australia, the Treasury, ASIC and other hangers-on. In determining its course of action, APRA said they also consulted with the Australian Competition and Consumer Commission. Wayne Byers said this is a targeted and judicious action designed to reinforce the stability of the financial system. In taking action, APRA is focused on ensuring the financial system remains safe and that banks are lending to borrowers who can afford the level of debt they're taking on both today and into the future. While the banking system is well capitalised and lending standards overall have held up, increases in the share of heavily indebted borrowers and leverage in the household sector more broadly means that medium-term risks to financial stability are building. More than 1 in 5 new loans approved in the June quarter were at more than 6 times the borrower's income, and at an aggregate level the expectation is that housing credit growth will run ahead of housing income growth in the period ahead. With the economy expected to bounce back as lockdowns begin to be lifted around the country, the balance of risks is such that stronger serviceability standards are warranted, Byers said. Together with other members of the Council of Financial Regulators, APRA will continue to closely monitor risks in residential mortgage lending and it can take further steps if necessary, they said. Now, it's also worth looking at what APRA said about what risks they're responding to. The current environment of very low interest rates and rapidly rising house prices means that pressure on household indebtedness is likely to remain heightened. Household credit growth is expected to exceed household income growth in the period ahead, further adding to concerns about overall household indebtedness. A more highly indebted household sector presents risks to future financial stability. Highly indebted borrowers are likely to be less resilient to future shocks, such as from rising interest rates or a reduction in incomes. Macroeconomic impacts can be material if such risks materialise, with international studies suggesting highly indebted households are more likely to reduce their consumption in the event of a shock, amplifying the impacts of any economic downturn. Household credit growth is increasingly being driven by lending to more marginal and highly indebted borrowers. In the June quarter 21, for example, more than 20% of ADI's new lending was to borrowers that had borrowed more than 6 times their pre-tax income. This is high by both historical and international standards, and without action the share is likely to increase further. While these trends have been emerging in the past couple of quarters, APRA and other members of the Council of Financial Regulators have been wary of intervening while large sections of Australia were in lockdown and many sections of the community were under economic stress. However, with lockdown soon to be lifted and expectations the economy will bounce back, APRA considers the balance of risks has shifted so that a timely adjustment to serviceability standards is now warranted. This step is supported by the other agencies of the CFR. Now, APRA raised the interest rate buffer rather than increasing the interest rate floor or imposing limits on high debt-to-income lending because, they say in the current circumstances, their view is that the interest rate serviceability buffer is the most appropriate tool to use. It acts as a cap on leverage, is relatively easy to implement, and will not have an impact on mortgage interest rates. APRA, they said, chose not to use an interest rate floor as a means of achieving a similar effect. It would also be relatively easy to implement and would not impact mortgage pricing, but would be more restrictive on owner-occupiers and have a lesser impact on investors. A limit on the extent of high debt-to-income borrowing would precisely target more highly indebted borrowers. Compared to raising the interest rate buffer, however, limits would be more operationally complex to deploy consistently and may lead to higher interest rates for some borrowers as lenders effectively seek to ration credit to this cohort. On balance, they said it was considered raising the interest rate buffer was the preferred response on this occasion, but it doesn't rule out that the other measures might be used in the future. So in terms of which borrowers might be likely impacted, the increase in the interest rate buffer will apply to all new borrowers. And across borrower cohorts, the impact of a higher serviceability buffer is likely to be larger for investors than owner-occupiers. This is because, on average, investors tend to borrow at higher levels of leverage and may have other existing debts, to which the buffer would also now be applied. On the other hand, first home buyers tend to be underrepresented as a share of borrowers borrowing at a high multiple of their income, as they tend to be more constrained by the size of their deposit. Now, in terms of the impact that this is expected to have, putting aside the impact from other aspects of serviceability assessments, a 50 basis point increase in the serviceability buffer will reduce maximum borrowing capacity for the typical borrower by around 5%. Given some borrowers are already constrained by the floor rates that lenders use and that many borrowers do not borrow at their maximum capacity, the overall impact on aggregate housing credit growth flowing from this they expect to be fairly modest. And in taking action in relation to mortgage lending standards, APRA is not seeking to target the level of house prices. Rather, APRA's objective is to ensure that mortgage lending is conducted on a prudent basis and that borrowers are well equipped to service their debts under a range of scenarios. Now, of course, this only really applies to ADIs because under Part 2B of the Banking Act 1959, APRA can only make rules in relation to non-ADI lenders if those lenders are considered to be materially contributing to risks of instability in the Australian financial system. But, they say, APRA is closely monitoring trends in the non-ADI lending, but does not consider there to be a basis for a policy response in relation to non-ADI lenders at this point in time. Non-ADI lenders currently account for quite a small share, under 5%, of total housing lending. So there's 3 points to make here. Firstly, APRA has stirred finally, although what they've done is relatively minor in the scheme of things, and it only impacts, of course, new borrowers. The fact that they've veered away from debt-to-income ratios, or LVR restrictions, is quite interesting, because we know that when the Reserve Bank in New Zealand intervened over there, they did target loan-to-value ratios and investors, and that did have a bit of an impact, although over there prices are still moving very fast. The point I want to make, though, is this does not help the many households who have got loans at the moment and are highly leveraged. And that leverage stems from two things. Firstly, lending standards have been very weak for a long period of time, and that means that many people have got large loans. But the other side of the equation is that household incomes have been consistently compressed in many parts of the country, partly because of COVID and the lack of hours, and partly because of general employment trends. Now, the problem that I see is that incomes are unlikely to heal anytime soon. Costs of living, of course, are continuing to rise, and there is the risk that down the track mortgage rates may rise as well. So this is definitely a financial stability risk moment, but it is also a risk on individual households. And what I want to communicate today is that it's really important for individual households to check their cash flows, to look at what their overall exposure is or could be if they're going to take a mortgage, and maybe be a little bit more conservative, because just because a bank says you can borrow X or Y doesn't necessarily mean that that is actually smart strategy. But overall, the intervention from APRA is relatively underpowered in terms of direct impact, but psychologically it will probably have a bit of a broader impact insofar that it shows that, one, they do recognise there are risk building, and two, they are prepared to intervene to an extent, even if, frankly, it's pretty much a wet lettuce. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.